Hi, welcome to our second video on Module 6's topic, shares. So we were previously talking in video 1 about how the shares are sold. This one is talking about stock splits. So what's happened is the share price is usually very high in this situation. So the company wants to reduce that down. So what they do is that they offer to swap your shares for a specific number. So that way they're going to increase the number of shares that are out there and the price will reduce down. So for example, if we have a 4-to-3 split, so they will give you 4 shares for every 3 shares that you have. So if you owned 300 shares before the split, now you're going to own 400 shares. This should bring the price of the shares down. So in this case, the price of the share should come down by 1/4 after the split. So now the share price will look smaller and hopefully they will, well, the idea is that it looks more appealing for investors to be able to buy. Another thing that happens is that the company will want to buy back your shares. So they might think that there are too many shareholders, perhaps they think there are too many shares out there. There might be specific shareholders that they want to buy out, or they want to give the capital back to shareholders. So they can do this on market or off market. So I've had this happen where I've received a letter saying, okay, we want to buy your shares. This is the price we're offering. In those cases that I've experienced, it wasn't compulsory, but it was just something to consider if you wish to do that or not. We've got some special terms that we use with shares. So just like bonds, we had the par value, which is the face value of the share. Then we have book value. So what are the shares, the shareholder equity worth in the company? Market value, so this is the value if they're trading on the stock exchange, what the value is there. So that's the market value. And then we have investment value. So this is the value that the investors think that the share should be trading for, or what they think it's worth. So for that, you'd have to assess return and risk. I mentioned briefly in the previous video that there are 2 types of shares. We were mostly talking about ordinary shares, but there are also preference shares. So both of them, you own a little piece of the company. Ordinary shares, there's no preference if the business liquidates. If you have 1 vote at an AGM. With a preference share, you have no voting rights, but you do get some preference if the company goes bankrupt. The ordinary shares, you get paid your dividends after the preference shareholders. So just like the name, preference shares, they have preference, so they get paid dividends first before the ordinary shareholders, and they also stand first in line if the company goes bust compared to the ordinary shareholders. So if you have ordinary shares, then you're going to be able to vote and receive dividends. How do they decide on paying out dividends? So the board of directors makes this decision. They think about what's going on in the economy, what's happening with the business. So as you know, last year things were not good, so they decided not to pay dividends, only small ones. So they have to look at corporate factors. What are they predicting for the next year for their sales? What are their growth prospects? And then they have to look at the market factors. So there are also expectations that people have of being paid dividends, and you can really upset shareholders if you don't pay them when they're expecting that and they have regularly received dividends. There are important dates connected with shares. So we have the date of record. So that is the date in which your name needs to be a registered shareholder of that company in order to be entitled to receive the dividend. So you've got to have purchased your shares early enough to go on to the date of record. Then there's the payment date, so the actual date that they pay your dividends. Well, we don't get checks anymore. We get it direct debited into our bank accounts. And then there's the ex-dividend date, 5 business days before the date of record, and that's used to determine shareholders' eligibility to receive a declared dividend. So if you're looking at buying shares around dividend dates, just be careful to check whether or not you'd be entitled to receive your dividend. So if you've got your hopes up that you're going to be getting a dividend that's being paid shortly, you actually need to make sure that you've got your name down as, or you've bought them and have your name on the record 5 business days before the date of record. Got some lovely maths here with shares. So I've got a group of formulas to go through. So we'll start off with our earnings per share. So we've got our net profit after tax, less the preference dividends. So remember, they get preference to be paid, so we take out the preference dividends amounts. And then we divide by the number of ordinary shares. So we're not interested in the preference shares, just the ordinary shares. And that'll tell us our earnings per share. So what is the amount of annual earnings available to ordinary shareholders? We talk about it per share. So the amount for ordinary shareholders is the profit after tax without those preference dividends over the number of ordinary shares that they have. A couple more formulas. So we've got our dividend yield. So we used a yield formula last week with bonds, similar. So the annual dividend, so the income received for the year from the shares, so the annual dividends received per share over the current market price of the share. So very, very similar to what we learned with the bond yield formula last week. So relating dividends to the share price and makes it a percentage instead of a dollar amount. Then we have the dividend payout ratio. So dividend payout ratio, the number of dividends per share over the earnings per share. So what's the portion of earnings that they actually pay out as dividends? They don't pay out all of their profits. So here's an example to work through. So assume this about a company. 1 million ordinary shares are outstanding. They've got $300,000 of annual preference share dividends, $2 million net profit after tax. The current share price for the ordinary shares is $25.50. Preference ones are listed separately. And the ordinary shares are receiving an annual dividend. So what I want you to do now is to calculate those 3 formulas: earnings per share, dividend yield, and dividend payout ratio. So earnings per share, net profit after tax less the preference dividends. Okay, so I'm going to stop talking now for a moment. I want you to pause this video and have a go at these formulas. Okay, so when you're ready, you can then check your answers. I'll put the slide up now. So earnings, oh no, one's covered up. And I can't remember the answer. Well, we can work it out. Earnings per share, so that's $1.70 per share. Dividend yield was 4%. What's the dividend payout ratio? 1.02 divided by $1.70, 60%. Okay, we'll do some more practice of that in class.